Hello everyone, thanks for joining us and welcome to today's Resources Rising Stars Virtual Investor Forum. I'm Nicholas Reid from Reid Corporate, and on behalf of our team at Resources Rising Stars, we're absolutely delighted to bring you the third in our popular investor webinar series, once again with an outstanding lineup of 4 resource company presentations. As many of you now know, this series is an online version of the regular investor lunches that we've been running in cities around Australia for over 10 years. And I'm pleased to say that the feedback from these webinars has been extremely positive. As long as many COVID-19 restrictions remain in place, these forums have proven to be an excellent way of staying in touch with our RRS community and to bring you the latest news and developments from our RRS companies. That said, we are encouraged by the progress being made across the country towards the phased lifting of restrictions and the roadmaps that are being established towards reopening the economy and slowly getting back to normal. With this in mind, we are continuing to work closely with all of our key stakeholders to firm up our plans to host the annual RRS Gold Coast Conference on the 10th and 11th of November this year. And we look forward to bringing you further news on this rescheduled event in the very near future. This will be the 18th consecutive year of Resources Rising Stars, and we're doing everything we can to make it happen and to do so in a manner that fulfills our objective of bringing investors and companies together while complying with health and safety guidelines and, most importantly, safeguarding the health and safety of all of our attendees. Before we get on with today's presentations, just a quick reminder about our Resources Rising Stars weekly wrap. This publication contains the highly influential column of Barry Fitzgerald, one of Australia's most well-regarded resource journalists, and an excellent column from veteran finance commentator Tim Treadgold, who looks at the week's resources news and events on the market. The weekly wrap is published every Friday morning. If you'd like a free copy delivered to your inbox, please go to www.resourcesrisingstars.com.au to register. Also, a quick reminder that everyone is in a listen-only mode during these presentations, and the chat function has been disabled. If you would like to ask a question, please do so using the Q&A tab on the right-hand side of your screen. And please remember to log your question before the end of each presentation so that I can put it to the speaker after his 15-minute presentation. On to the business of today. Our first presenter this morning is Fenix Resources. Well, the surge in iron ore prices through the $100 a tonne mark has been one of the big stories in recent weeks, spurred on by the recent closure of several major Brazilian mines due to the COVID-19 pandemic. The question for investors is, how do you get leveraged exposure to this new iron ore boom? Fenix is one of the few opportunities. It's preparing to develop its Iron Ridge project in WA's Midwest. Iron Ridge has a forecast capital cost of just $11.9 million, and the first shipment is scheduled to take place just 4 months after the start of construction. Fenix made its debut at RRS at our summer series in December. To bring you up to speed with what the company has been up to since then, and more importantly, where it's going in the next few months, I'd like to welcome the Managing Director, Rob Riley. Thanks very much, Rob.
Thank you, Nicholas, for that nice introduction, and thank you for the listeners out there. Fenix Resources, we've only been around for about 18 months. We've made rapid progress with our iron ore project. We are a single asset focused company at the moment, and we hope to bring this project into production by the end of the year. I'll just dwell briefly on our important disclosures that we all must adhere to, and just go on to Fenix, the company. So we've, as I mentioned, we have one single project called the Iron Ridge project, which we acquired in November 2018, should I say. We rapidly started a drilling program there and delineated a resource. We then did an infill program, and we came up with a 10.5 million tonne resource at 64.2% iron. So the grade is the differentiating factor in what we have as our asset. All tenements are now granted, and we've got a mining proposal in with the Department of Mines. It's been there for nearly 2 months, so we're closer to the end of the process than we are at the start. We're what makes a project differentiated as well is that there's a lot of infrastructure already in place. There's 490 kilometres of sealed road that takes us to the project area. We've got a Geraldton port which is underutilised at the moment and has heaps of capacity. We expect a final investment decision in July. The other key attribute is our speed to market. So 4 months from time of final investment decision to when we expect our first shipment. That's from the contractor schedules given in our mining tender process. And why is it so quick? It's because all the infrastructure is there, and basically the ore starts at surface. It's a very soft and friable ore, and requires only mobile and modular crushing and screening. So it's a straight DSO product, no beneficiation required. Our capital costs, as Nicholas mentioned, are $12 million. And our forecast cash costs are $77 Australian per tonne, which is quite high, and we admit that. But basically, because we've gone with this capital light model, you can't have a capital light model without having a unit cost heavy model. But we think that's still comfortable for the product we're about to produce. Our feasibility study was based on very conservative iron ore price forecast, in our opinion, and had an NPV of 54 million and an average annual EBITDA of 16.4. As Nicholas alluded to as well, the iron ore price has been very buoyant, and we think that we're in for another 1 or 2 good years of iron ore price at the very least. There's no supply response available from the majors to pick up the slack of the Vale shortfall. So we think our little niche production, which incidentally is only 1.25 million tonnes per annum. So we're hardly going to flood the market. So we'll clearly be a small niche boutique producer. So our enterprise value at the moment is extremely low at 21 million. With the current iron ore price, we would make multiples of that in EBITDA just in our first year. A quick overview of our capital structure. As we mentioned, we have an enterprise value of 21 million, a market cap of about 24 million. So pretty low valuations in our opinion, given our speed to market. We've got a very small board at the moment, but made up of quite specialised people. So our chairman, Garrett Dixon, is a civil engineer. He's been involved in mining construction and mining operations for a very, very long time, longer than me. And we actually first met in the construction of the Yandi iron ore project for BHP in 1991. So we've got when we were both involved in the construction of that project and the ongoing operations. And Gary Plowright, our executive director, is an ex-Atlas Iron employee, known to some of our other presenters here. A good hand, very, very skilled in the permitting and logistics side of things. The Iron Ridge project was acquired, as I said, by 100% by Fenix in November 2018. A mineral resource was estimated, as I mentioned before. Deposit is on a granted mining lease. We had a little bit of issues with getting our miscellaneous licenses and general purpose lease granted, and had to go through a negotiation process. That was all completed. Those licenses and leases were granted in April, May this year, and as I said, in March, April, and we submitted our mining proposal to the Department of Mines. A feasibility study was conducted and completed within 12 months of when we acquired the project, and a maiden ore reserve of 7.8 million tonnes at 63.9% iron. And very simple operation. You wouldn't get much simpler geology. It's very standard iron ore mining methodology here. Just one wide BIF unit, which is very high grade. There's a coincident narrower BIF unit some 40 or 50 metres away, which gets mined coincident with the high grade part. It's very simple, 1 excavator, 3 trucks to start off with. By the end of the project, we'll probably still have 1 excavator and maybe 6 or 7 trucks as the pit deepens. There's consistent grades from most of the way down. The first 20 metres or so of the deposit is slightly more weathered and will probably produce lower grades. And by low grade, I mean we'll probably do 62% iron rather than 64 or 65. But at the end of the project, we're producing 66.5% iron, which is a very premium product. Drill and blast is very simple. As I said, the feasibility study was based on a life of mine of 6.5 years. Very uncomplicated processing as well. As I mentioned, it's a DSO product, 64% average in the ground, so it doesn't need any beneficiation. A very soft crush. The crushing work index and the abrasion index of this product is very low. It's not a Pilbara ore type. It's very soft and friable ore, so it needs a very light crush and basically just screening to screen out your lump and your fines with a multi-deck screen. So very simple mining, very simple processing. The challenge really for us to wrap our heads around was how we're going to get it to port. There's no railway line and there's no likelihood of a railway line anytime soon, so we have to truck it. That's been done before. Murchison Metals mined the Jack Hills project, which is another 150 k's further away than we are, from 2005 to 2011, and used almost exactly the same haulage route as us. So we're not reinventing the wheel. We've got all the approvals from the shires to use their road network. But that is our greatest cost, is road transporting the ore from site to the Geraldton port. Thankfully, we've got a port that's very underutilised at the moment. It's a bit different from the halcyon days of 2005 to 2007-8, when you couldn't get any export capacity at all. So Geraldton has about 3 storage sheds that are unutilised or underutilised, and they have a dedicated iron ore shipping berth, good for 3,500 tonne per hour, which is only being used by one customer at the moment at about 25 to 30% capacity, so heaps of capacity. We're in regular dialogue with the Geraldton port. We have a cooperation agreement with them, which we intend to change into a contract when we enter final investment decision. We also have a cooperation agreement with our trucking guru, so to speak, Craig Mitchell, who was CEO of Mitchell Corporation and also chairman of Mitchell Corporation at one stage. Mitchell Corp did the trucking for Murchison Metals, so he's got a lot of expertise in that area. We established a joint venture with Craig, where he owns 50% of the trucking joint venture and Fenix own 50%. That's a little bit novel, but it's sharing the risk and sharing the reward, and getting the cheapest possible price for what is our key cost component. A quick snapshot of our feasibility study. I won't linger on this too long. Basically, as I mentioned, the initial capex is $12 million. We've got another $3 million of capex to spend in the first year, generally resealing a road that's already sealed that they believe it's only a sand seal, so they believe we'll have to do a chip seal, but we've got up to 24 months to do that, to reseal that road. So we should be well and truly into very positive cash flow by then. As I mentioned, 6.5 year mine life, which is not a lot, but we are limited by our geography. We have that one granted mining lease, and we're surrounded by Sinosteel Midwest, who own most of the tenure in that area. I think that that's changed a lot for Fenix is what's happened on the macroeconomic front. We used a iron ore price in our feasibility study of 111 Australian. It's currently well over $150 Australian, so that's all margin for us at this stage. We've also seen a rapid deterioration in the diesel price. Diesel is a large input cost into our business, mainly for road transport. So there's a substantial, more than 30% drop in the diesel price, and it's recovered a little bit, so it's only about down -22, but that's still favourable for us. As I mentioned, the big thing is the iron ore price, which is 34% higher than what we had in our feasibility study. I won't linger on capital and operating costs. I think I've covered that in detail in the discussion so far. Suffice to say that road transport is 56% of our C1 costs. It is a large component, hence the joint venture arrangement where we think we've got an open book basis of cost discovery, and we can optimise that to the best of our ability. So what have we done in the last 18 months? We've acquired the project. We've done a mineral resource upgrade. We've entered into a strategic agreement with the road transport specialist. We've entered into a cooperation agreement with the Port Authority. We've done another mineral resource upgrade, which gave us a further kick and also put nearly all of our resource into the indicated category. We completed the feasibility study. We've been able to declare maiden ore reserves. All our tenure for project startup has been granted, and the mining proposal has been submitted 2 months ago and should be pretty close to making a decision. What are we going to do in the future? Well, hopefully we get our approvals by the end of this month. We'll go into offtake and financing, finalisation of discussions, entering a mining contract, entering road transport contract, entering port agreements. We hope to do final investment decision in July. Why can we do that so fast? Because we're already in advanced discussions with all these groups and really just waiting for project approval before we can sign these things off. So looking forward to entering into offtake and financing arrangements, which we've tried to leverage our offtake position to get the best financing solution. And we, as Nicholas alluded to, because our ore's on surface, because all the infrastructure's there, very quick to market, 4 months from start of construction to first shipment. So we still have a strong target of being able to ship our first ore by the end of this calendar year. Just summarising, we aim to be a supplier of premium grade iron ore at this stage, but we will look to expand our profile once we prove our concept in this area. We've got a great foundation asset. We understand it's relatively small, or well, I've been trying to train myself to say it's niche or boutique, but it is high grade and it's high margin at these current prices. We're really focused on developing this project, and we're very close to being able to pull the trigger on that. We plan to use our relationships, particularly with our off-takers and financiers, to repeat this model again in further project acquisitions going forward. So great jurisdiction, great grade, speed to market, very low capital intensity. Those are the snapshot and the key attributes of Fenix Resources. And I'd like to thank Nicholas and his team for giving us the opportunity for this presentation. Thank you very much.
Thanks very much, Rob. Great presentation. We do have a number of questions that have come in, so we'll just try and whip through them quickly. I'll try and get to all of them. Firstly, can you say, commenting on your funding strategy for the project, will you need to raise any additional capital?
Well, potentially not. I mean, we've always tried to use our offtake position. There's been a lot of people that sort of want you to press you to sign offtake very quickly. We think we've got a product that sells very easily. It's a high-grade product, and we've been trying to get our offtaker to help us to finance the project. So I can't categorically say yay or nay on that. It depends on where we can get to with our financiers. But the heavy lifting will be done through the offtake and financing.
Excellent. Another investor's asked, can you comment briefly on the status of your discussions with traditional owner groups, and are there any sensitive sites at your project?
Our discussions have been very productive, and I suppose we've been lucky enough to have all our tenure granted. Now, you wouldn't have that tenure granted unless there was some common ground and rapport with the traditional elders and the owners of the region, and that's why they allowed us to get that granted. We've got a mining cooperation agreement, which all commercial terms have been agreed upon with those parties, and it's basically in the twilight of getting fully signed and executed. and we hope to achieve that in the next couple of weeks.
Excellent. And who are your intended customers?
Well, there's lots of customers in the iron ore space, as you know, and we've had no shortage of people interested in our product just because of the 64% grade. Most of the new iron ore projects out there are of the lesser grade. So, with the environmental standards in place in China and emission restrictions, there's a real advantage in having high grade ore. But saying that, we're a producer of 1.25 million tonne per annum in a market that's 1.4 billion tonnes. So we're a very small player. But as I said, we've had no shortage of interest from off-takers, whether they be traders, whether they'd be tier one producers themselves, or whether they'd be top class off-takers themselves, particularly the Japanese.
Fantastic. Just final quick one. If you could get your crystal ball out, and investors said that the current high price for iron ore has been driven by some of the issues in Brazil.
Yep.
Where do you see the longer term price going for iron ore?
If I knew that, I'd be a very rich man. And I've been involved in forecasting commodities for a long time. It's very difficult. All I know is, what I'll leave you with is that iron ore has 4 major producers that produce 70% of the seaborne trade. If they have an issue, then it flows through to the supply side. Demand's strong. It's likely to continue to be strong. Economies are stimulating. Steel is a great stimulus user, I suppose, because it's used in infrastructure. So I would say that it's going to take a long time, at least a couple of years to recover, and there's no shortage of other issues that could happen to tighten the market up before. We talked a lot about how OPEC was a great cartel. They produce a very small percentage of the world's oil compared to what those 4 producers do. And they've all stopped. What's been different is they all have the mantra of value over volume at the moment, and there's been no supply response yet. And I doubt whether there'll be a huge supply response, as there was in the mid 2000s, which saw a flood of iron ore come into the market in the early 2010s.
Fantastic. Thanks very much, Rob.
Yes, thanks.
Well, you don't need a crystal ball to see that there's plenty of news coming for Fenix. Thanks very much to Rob for a great presentation. Our next presenter is Stavely Minerals. Stavely has been the epitome of the determination, resilience and vision that's required to make big mineral discoveries. Reuniting the team that led the successful gold company Integra Mining, Stavely listed on the ASX back in 2014 as the only resources IPO of that year. It took the company 5 years and some 49 deep diamond drill holes at its namesake Stavely Copper Gold Project in Western Victoria before it landed the killer blow with hole number 50 in September last year, intersecting 32 metres at 5.88% copper and 1 gram of gold. Resource drilling at the Cayley Lode discovery is now well advanced, and earlier this week, Stavely reported yet another monster copper hit. To tell us where this exciting discovery is up to and when we can expect a maiden mineral resource, I'd like to welcome Stavely's Executive Chairman, Chris Cairns. Thank you, Chris.
Thank you, Nicholas, and thank you to Resources Rising Stars for the opportunity to join this web seminar. This is the first one I've done. We've got a animation in here, which was the first animation we've ever done, so we'll see how that goes. I might be a little bit out of sync, but I think it's a really good way of showing investors the 3-dimension of the deposit and where the opportunities lie. So let's get amongst it. This presentation is lodged with the ASX and it will be available on our website, as will the animation. So when we went to Victoria, nobody wanted to be there. They said it was the worst state in Australia to explore. So we were able to get a first mover advantage in an emerging copper belt in the Stavely project, in the Stavely Arc. And since that IPO, we've been spending a lot of money drilling. As Nicholas mentioned, we drilled 49 holes without a great deal of success, some sniffs, until we really understood what this deposit really was. It wasn't a porphyry per se. It was more a magma style Arizona type deposit. And that was really when the penny dropped and when we really started to hit our stride and led to the discovery drill hole. So as Nicholas says, we are in a resource drill out. It's a new style of mineralization, very exciting, never been seen in Australia before. And we have a number of additional discovery opportunities, both within the deposit and at other prospects along the belt. And we've maintained that dominant land position. We're well funded. At the moment, we have about $10 million in cash, 3 rigs spinning. So drilling's a bit of an expensive habit, but we're well funded for the moment. Just a bit of the corporate slide. You can see where in September, where we've made that discovery, the share price has jumped. It sort of slid off a little bit since then, and the pandemic certainly has rocked markets. But we're coming back strongly. We're getting a good string of drill results, and you know, we don't see this as dissimilar to the global financial crisis, where at our previous company in Integra, we went down to 8 cents during that crisis in the market, and eventually we agreed to take over at around 50 cents. So nothing really changed between those two values except the sentiment in the market. The story was strong. So really what we're doing is that we're in a really good space in terms of copper. The global economy needs copper for infrastructure projects, but also this transition to a low carbon economy is a really strong thematic with electric cars, wind power, solar power, et cetera, et cetera. So copper is definitely the space to be. And certainly it's the space to be when you're in a first world jurisdiction. And those sorts of quality projects don't come up very often. And we believe that we've discovered a new belt. So that's the exciting part. So it is in Western Victoria. It's about 3 hours to the west of Melbourne. It's very good infrastructure, a wind farm nearby, 65 megawatts, where a railway line goes straight through the project area, goes to the deepwater port of Portland. And, you know, a very good position and a very good ground position. We focused on the Thursday's Gossan deposit. It had a chalcocite-enriched blanket that exists somewhere between 30 to 80 meters below surface. None of the previous explorers recognized that this actually wasn't a chalcocite blanket developed on a porphyry. It was actually developed on the surface expression of these high-grade veins. We've now realized that, and those high-grade veins occur on the northeast and eastern margins of the porphyry system, and they are controlled by major structures. And that's what we're drilling out now. So up in that top portion, we had focused on drilling some porphyry magnetite veins. They looked very much like Cadia Ridgeway deposit, and certainly a worthy prize to be chasing. And that culminated in a hole 49, which is a 1.8 kilometer deep drill hole seeking the deep porphyry. That hole was spectacularly unsuccessful. Having said that, we had a couple of high-grade hits at depth in a series of holes that I'll touch on later on. But our consultant said, well, look, maybe you shouldn't be looking for the deep porphyry. Maybe you should be looking for surface expression of this higher grade material you've seen at depth. So hole 50 was planned and drilled in September last year, and it intercepted 32 meters at almost 6% copper and a gram gold. And really, as a geologist, to look at the color of the core and the nature of the mineralization, it was really, we knew we were onto something special. If you had a stick of core that was 100% chalcopyrite or copper sulfide, you would get 26% copper. But in 2 meter interval, we got high grade 40% copper, which is these higher order copper minerals, bornite and chalcocite. So we knew it was a very special system. So we've been drilling consistently since then with 3 and 4 rigs at a time, really trying to map out where the mineralization is. It's structurally controlled on a northwest trending structure, and we've now mapped it out intensively over about 700 meters, but the full strike of the system at the moment is 1.5 kilometers. And that's very typical of the type of system that we've got in these magma Arizona type systems. So in long section, this is what it looks like. We've got a low angle structure there that's a little offset, but it doesn't make much difference in terms of where the mineralization continues. And we're currently trying to map it out as a resource in that 200 meters depth to surface, ostensibly what you would consider resources available for open pit. And we're starting to get a few deeper hits now, and they would give us encouragement that there may be potential for underground as well. This is the announcement from, or sections from the announcement on Monday. On the left-hand side, hole 87, quite a substantial hit of 87 meters at 1.74% copper and 0.57 grams gold, with higher grade intervals of 24 and 9 meters at around 4% copper and a gram and a bit gold. So it really is quite special. The metallurgy looks very good. It's a low arsenic system. And we have been quite surprised at the consistency and coherency of the mineralization along strike in this structure. You see the low angle structure there, offsetting mineralization. It offsets about 50 meters to the west. And importantly, in that announcement, we described hole 85 that intercepted mineralization below the low angle structure. And now we're starting to get a number of hits under that low angle structure, giving us the confidence the mineralization probably extends to in excess of a kilometer depth, which is the depth that we've hit it in other structures nearby. So we used the Magma Arizona model. It's very similar in style and character, and these systems are multiple high-grade structures. They're vertically and laterally extensive, and you can map your way through the system by the species of the copper sulfides, so that it changes as you get closer to the source porphyry, which is, in the case of magma, the resolution porphyry at depth. So that top of that mineralization, the porphyry is 1.5 kilometers down, but Rio Tinto and BHP are seeking to develop that deposit in Arizona. So this being the little fly through, let's see if we can get this going. 3, 2, 1. No. Let's go back. I haven't got it going here. How's this? Here we go. Okay. All right. So map of Australia down in the right, bottom right corner, Victoria. And our tenure just 3 hours drive east of Melbourne. The land use is broadacre cropping mainly and lesser grazing. There's no hobby farms or anything like that. This is industrial scale cropping through the area. Just south of the Grampians National Park, but well away from it, say 25 kilometers. Number of porphyry and copper prospects along the strike of the volcanic belt. And we've been focusing primarily on the porphyries around Thursday's Gossan. There's 2 other porphyry prospects within about 10 kilometers. There's a chalcocite blanket, as I mentioned, developed on Thursday's Gossan, structurally controlled mineralization. And that has a resource of about 28 million tons at 0.4% copper. So as we start to think of open pit on the higher grade structurally controlled mineralization, that chalcocite resource will come into the pit as low grade mineralization with the high grade structurally controlled stuff mined as well. So just flying into where that resource lives on the ground, as I say, broadacre cropping throughout the area. It's quite flat, a bit challenging to work in at the moment because there's very little drainage and it rains a lot there during the winter. But this footage was taken only, say, a month ago. The crops have been planted and 4 rigs in a row there. So we're intensively drilling this thing out. We've done quite a bit of drilling in the early days, and you can see some of the deeper holes on the left-hand side there. We had a great deal of encouragement from the assays and from petrology and mineralogy that we were sitting near a porphyry. But as I say, we drilled a deep hole that was a duster, and we were told to look for something a bit higher grade, shallower. And so this is hole 50. We've got that 32 meters at almost 6% copper and a gram gold from about 62 meters, so very shallow. Looks beautiful, you know, a stick of core that a geologist could fall in love with. Since that time, we've done a lot of drilling. So we'd be up to hole 95 at the moment. So we've drilled another 45 holes into it. As I say, the mineralization has been surprisingly consistent, very coherent body of mineralization. That hole 87 is that little blue bob in the gap. But we've had other hits in other structures parallel to this structure. So the hits are almost a kilometer deep, and we've defined the strike of the one lode to 1.5 kilometers. We draw the analogy between Butte, Montana, and Magma, Arizona. And the Magma deposit, as I say, multiple high-grade mineralized structures. This was mined for 86 years before BHP bought the deposit. It's vertically and laterally extensive, in this case, in excess of 1.5 kilometers tall and probably 3 kilometers laterally. And those multiple mineralized structures lead down to the porphyry at depth. And the sulfide species are zoned, so it really maps you out and tells you which direction you should be going to be looking for the porphyry. And certainly that's an evolving story with Stavely. We've recently done some seismic. We're doing a lot of petrology, etc. And eventually, say near the end of this year, we're going to have a stab at the deep porphyry with a couple of holes. So it's very significant size of system. We're only looking at the top 200 meters of one structure so far. This is the EM conductivity image showing that there's the chalcocite blanket, and then you can see a number of mineralized structures within that EM image. We're only focused on the one at the moment, the Cayley structure, but the copper lode splay and the north-south structure, we have hit this style of mineralization in both of those. The copper lode splay in about 550 to 600 meters depth in hole 32 and hole 44, and then on the north-south structure in hole 44 and 44 wedge 1 at about 850 to 900 meters depth. So a very tall system, and each of these structures should be mineralized to those sorts of depths and beyond. So this is brand new seismic, very early and preliminary interpretation showing a magma chamber at depth with high-level porphyries and a whole bunch of structures, all of which could potentially be mineralized because it's a bloody big system. The gravity lows show the alteration around these porphyries. So we've got Thursday's Gossan up the top there, Junction in the middle, and Mount Stavely below. Really, we've only focused on Thursday's Gossan, but a series of these pull-apart basins provide space for the porphyries to come up through. So there's a lot of prospectivity along strike. And we've got a lot of drilling to go. We're only drilling out 200 meters of a structure we think is mineralized to at least 1 kilometer depth. We've got 2 other mineralized structures that we really haven't gotten around to yet. And so there's a lot of work in front of us. And then we have the porphyry at depth as well. So we'll have a big swing at that near the end of the year. You can see in the EM data that those structures are relatively well mapped out. As I say, the ultramafic contact fault is the one that hosts the Cayley lode. And we're focusing on the shallow portion of that at the moment, but there are other structures that we need to get to, and they'll add to the potential economics of this project as we flesh them out. And this is what it looks like in section, multiple hits on multiple structures, and the grades are quite good and point you to that hit at 850 meters in hole 44 wedge 1, 18 meters at 3.6%. Beautiful hit. And if we can get more of those on these other structures, we can demonstrate for 1 kilometer's height, we've got the shallow, say, open pittable, if you will, resource. And then we look to bring that down to depth. And we bring hits in the copper lode splay up to surface, and likewise deep hits in the north-south structure up to surface. And in the seismic, we would interpret that there's a number of other structures that could potentially host mineralization that we haven't seen in the drilling yet. So we need to test those regional targets, and of course go for the porphyry. So really, the key message is that we're a first mover in a new copper province in Western Victoria. We've made a discovery. It looks like a bloody big system. It's mineralized in our drilling from 62 meters down to over 1,000 meters. We're just drilling the shallow bit at the moment, and there's a lot to go. Thank you.
Thanks very much, Chris. Lots of questions coming in, so we'll just quickly try and get through them. We'll try and deal with them as many as we can. Firstly, an investor has asked, you're in the middle of prime farming land. How are the environmental permissions progressing, and what's the sentiment of the local farming community?
Look, I think, for example, we had, when he was the minister, we had, Dan Tehan, the education minister, who's the local federal minister, and also the resources minister, trying to remember his name. He had to step down. But anyways, we had them on site looking at the drilling for the junior minerals exploration incentive, and they wanted to see what a junior explorer who doesn't have any revenue do. Happens that we introduced them to the local landholder where we were drilling at the time, and they said, well, how do you feel about these boys being here drilling on your property? And the answer was, well, look, the local primary school has had to shut down, and the kids have to bus up to Dunkeld to go to school. local footy club didn't have enough players. They had to amalgamate with Lake Bolac Dam the other direction. There's no kids on the oval kicking the footy. We really need something in the area to diversify the economy and keep families in the country. And so that is an overwhelming sentiment. It's echoed in the local councils. So they want to diversify the economy and they want well-paying, skilled labour jobs in the regional areas to keep families there.
Excellent. And other investors ask, what sort of production time frame could you envisage for a project of this scale?
Well, look, I think where we're at with the drilling, we've probably got another 18 months worth of drilling to do. We'll flesh out the near surface resource again that you would reasonably consider might be available for open pit mining. And then we need to start fleshing out the underground potential. And it may not be that we need to drill it into a resource to a kilometre's depth. That would be too costly. And you'd probably do that from revenue as you got going. We're going through approvals and feasibility studies is probably another 2 years or so. So we're probably looking 4 to 5 years.
Great. And then another investor just asked, when discussing the idea of a new province, when will you test some of the other opportunities in the land package, Mount Stavely, Junction, etc.?
Yeah, that likewise is slated for later on this year. It's really a case of logistics where, as I say, it's wet there in the winter and it's more difficult to support drilling activities during the wet, but it sort of gets a bit more manageable from the 1st of October, so it'll be later in this year.
And just one final quick one, what's the best geological analogue and why? I think you may have answered.
Yeah, look, we believe it is magma. We're showing all of the attributes of this type of system, and we've written a couple of technical papers that we'll put up on the website that sort of explain the analogy between this and magma, but it's to do with how big it is, how it's manifested as high-grade lode-style mineralization, and also the sulfide distribution and how it really replicates what we're seeing at magma. And it's a well-documented system.
Fantastic.
Thank you
very much, Chris.
Cheers.
Our next presentation is from Liontown Resources. Over the past 2 years, Liontown has emerged very rapidly as one of the most exciting new lithium growth stocks on the ASX, underpinned by what has evolved into a Tier 1 discovery at its flagship Kathleen Valley lithium project in WA. Liontown recently delivered its third successive upgrade to the Kathleen Valley resource, clearly establishing the project as one of Australia's, indeed the world's, premier lithium deposits. The new resource has provided the foundation for an updated pre-feasibility study, which will incorporate a number of key project enhancements and which is due for completion later this year. In addition, Liontown is also exploring for nickel at an exciting new project just north of Perth. To tell us more about where the company is up to on both of these fronts, could you please welcome Liontown's Managing Director, David Richards. Thank you, David.
Thanks, Nicholas, and thanks for the introduction, and good morning. Today, I'm going to provide an update on our Kathleen Valley project and also an overview on our new Mora project where we've just started exploring. The standard disclaimer, which I won't dwell on, but I will draw your attention to it, and this presentation will be available on our website. Okay, so these are the projects we have in Western Australia. Kathleen Valley, which I'll be talking about, it's a world-class resource. Most of the resource is measured and indicated. As Nicholas indicated, we're currently undertaking an updated PFS study, and the results of that should be out by early Q4 this year. At Mora, we've just started exploring in an exciting and an emerging new mineral province in Australia. It's largely unexplored, but our early results have been extremely encouraging and we look forward to keeping working there. I won't talk about our Buldania project in southern Western Australia, but there is a significant resource there, a lithium resource, which I'll remind you about, of 15 million tonnes. So together with Kathleen Valley, we actually have 170 million tonnes of lithium resources in the best mining jurisdiction in the world. All of our projects are 100% owned and close to established modern infrastructure. Okay, Kathleen Valley, we started working there in 2017, and since then the resource has grown from about 21 million tonnes in September 2018 to the current resource of 156 million tonnes. So the deposit is firmly entrenched as a tier 1 hard rock lithium deposit. It's top 5 in Australia and top 10 in the world. So it's a globally significant lithium resource. The current resource is in excess of 1,700 metres long. We've intersected it as deep as 600 metres below the surface. It remains open to the northwest and at depth. But saying that, we're not planning on doing any more resource definition drilling, particularly in the short term. We think that having a 156 million tonne resource and a possible 40-year mine life is probably enough for now. Of the 156 million tonnes, 80% of it is measured and indicated, which means we have available to us 125 million tonnes to convert into reserves, which will happen as part of the PFS study, which is happening at the moment. The resource was calculated or estimated at a cut-off grade of 0.55%, which is a fairly standard number in the industry. But you can see there we can increase the cut-off grade at Kathleen Valley to 1%, and we still end up with 130 million tonnes at between 1.4 and 1.5% lithium oxide. So it's still a very significant resource at whatever cut-off grade you use. I've mentioned we've grown the resource over the years, and this slide here is just a graphical comparison of the resource that we prepared in July last year compared with the resource we have now. And the reason this is important is that the July 2019 resource is the resource that we use to estimate, or used for the basis of a PFS study that we published last year. And you can see that that PFS study had some pretty good numbers in it. So if you look at this slide, the blue bars are the tonnes for the 2019 resource. The red bars are the May 2020 resource figures at different cut-off grades. And the grey and green line are the relative grades. So you can see we've more than doubled, well, just doubled the resource since July 2019, but the increase in contained lithium is actually 120%. And the reason this is because there's been a significant increase in the grade compared with the July 2019 resource. So these are the results from the PFS study that we put out in December last year. And as I said, they were based on the smaller July resource. So a smaller, lower grade resource than what we have now. So the 75 million tonne resource converted to a reserve of 50 million tonnes, so a very good conversion rate. And based on a mining rate of 2 million tonnes per annum, we had a mine life of 26 years and free cash flow over life of mine of heading towards $2 billion. So some very solid numbers came out of this PFS. But these results are now will be superseded by the new PFS, and we believe that the new PFS will significantly improve on these numbers. And I'll now talk about why we think this will be the case. Okay, the drilling that we did subsequent to the July 29 resource and also subsequent to the PFS we released in December intersected a lot of high-grade mineralisation at depth, and it's fair to say a lot more than we were expecting. So the new PFS will now look at accessing these higher grades much earlier in the mine life. And I suppose the way to demonstrate that is the previous PFS assumed an average mine grade or an average grade of lithium of about 1.1% for the first 10 or 15 years. The new PFS will assume an average mine grade of around 1.6% for the first 10 to 15 years. So you can see a significant increase in the grade that we'll be mining. And we'll do this by a combination of underground and optimise open pit mining. By accessing the higher grades earlier, we'll see a significant reduction in unit costs, mainly because we'll be producing a lot more concentrate for the same amount of tonnes we mine. And the other advantage we have is because we'll be going underground mining, we'll decrease the dilution from the host rock, which will help us with our deleterious elements. And all this combined will obviously shorten the payback for the project. The other significant thing that the new PFS will consider are process improvements. The previous PFS did not include a tantalum circuit. We knew we could get tantalum out of the deposit, but we didn't have enough data at that point to include it in the PFS. We've now confirmed that we can produce a decent tantalum concentrate at a decent grade, and the next slide will show you that. The other thing we're going to do in the new PFS is we're going to use a process or a flow sheet which just involves whole-of-ball flotation. And the reason we're doing this is actually as distinct from the conventional processing routes that most of the current producers are using of combined DMS flotation. The reason we're going to use whole of ore flotation is because we think it's a lot simpler. It maximises the amount of tantalum we recover because we can actually treat all the stuff we mine, and it consistently produces higher grade concentrates than the DMS flotation process, and I'll show you that on the next slide. The other thing we're doing as part of the PFS is a scoping study on potential downstream opportunities. We're not planning, Liontown as a junior is not planning to go down the downstreaming path, but we believe because of the potential long life of this mining operation that it has the potential to attract a strategic partner who will be interested in downstream processing, and we want to understand what that involves and also be able to provide a potential partner with some of the basic costs if they want to go that way. And being based in the Eastern Goldfields, there's a lot of advantages. For instance, downstream processing in the lithium space needs a lot of sulfuric acid. There's a lot of sulfuric acid surplus sulfuric acid in Kalgoorlie, for instance. Okay, seriously out of my depth here talking about this stuff, but I will give it a go. I talked about the processing. The top schematic there shows a very simple whole of ore flotation flow sheet. We basically crush, we grind, and then we put the product through a magnetic and gravity separation, and that's where we concentrate the tantalum. And one of the other advantages of concentrating the tantalum at this stage is it sucks out, the magnetic separation sucks out a lot of the iron. We don't have a lot of iron in the product to start with. The iron is introduced through contamination from host rock and also contamination through the grinding media that you use in the milling. And having magnetic separation at this stage means that we can decrease the amount of iron that goes into the flotation and subsequently decrease the amount of iron that ends up in the concentrate. As I've said before, we can produce a decent tantalum concentrate. We think the current test work shows that we can recover 56% at an average grade of about average concentrate grade of around 15%. The mineralogy of the tantalum concentrate it suggests to us that it'll be a fairly straightforward exercise to upgrade this tantalum concentrate further and produce 25 to 30% tantalum concentrate at an off-site facility. I mentioned previously that the whole of ore float produces a higher grade concentrate compared with the DMS flotation route, and the schematic on the bottom left of this slide shows a number of grade recovery curves at different feed grades. So I've got feed grades there of 1%, 1.4% and 1.7%. The DMS flotation grade recovery curves are dashed, and the whole of ore float grade recovery curves are solid lines. So if we look at the 1.7% line, for instance, the whole of ore float, and 1.7 I will point out is about the underground mining grade. 1.7 produces a concentrate in excess of grade of in excess of 7% lithium oxide, whereas the DMS float process produces around the 6.5%. At 1.4%, which is about the average grade of the proposed open pit, whole of ore float produces a concentrate grade of upwards of towards 7%, and compared with the DMS, which is closer to 6%. And you can see for the lower grade material at 1%, the DMS flotation can't even produce a 6% concentrate. So huge advantages to going down the whole of ore float process. I think everyone's aware of the issues with lithium at the moment, but long term the consensus is the demand will be back, and our production, the way things are set up at Kathleen Valley at the moment, we're on track to be in production when the demand or the market is predicted to be back in deficit for lithium. Infrastructure is fantastic. For Kathleen Valley, we're next to a sealed highway that goes to the port of Geraldton. We have power lines, we have natural gas pipelines, we have existing mining infrastructure. It's a very straightforward deposit to develop. We're on flat ground, the water's good, etc., etc. So you couldn't get a better deposit from an infrastructure point of view. So since we started work at Kathleen Valley, it's come from a resource of 20 odd million tonnes to the current resource of 156 million tonnes. So we've consistently met our milestones, or in fact we've exceeded most of our milestones. Our next major milestone will be the updated PFS study, which is due for release in early Q4 this year. We'll then follow that up with the DFS. We'll move straight into a definitive feasibility study after that, which is due for completion in September, October 2021. Okay, Kathleen Valley, great long-term value for the company. Mora provides a bit of exploration sizzle, which I think a lot of investors in this space like. The Mora project, it's located in the same geological terrain of Chalice's Julimar discovery. We acquired the tenements back in 2018, 2019 as part of a proactive generative strategy for battery metals, the battery metal in this case being nickel. There has been some work, exploration work done at Mora back in 1968. Poseidon actually were on the ground. They got some very good nickel numbers, but then they made a discovery out near Laverton, and that was the start of the nickel boom, and they never came back. Saying that, most of our project area is unexplored. We own the tenements 100% again. They're granted. We have access agreements in place with the farmers, and it's an hour and a half from Perth, so it's fantastic. The geology map I showed previously, it's not compelling that the geology is the same at Mora, but the geophysics does show it very well. On the left, I have a gravity image. We have a number of strong gravity anomalies at Mora, similar to the gravity anomaly at Julimar. These gravity anomalies are telling you that there's mafic, ultramafic intrusions there, which are prospective for nickel sulfides. And then when we zoom in, we have a magnetic image that just confirms that. So we have a number of very strong magnetic anomalies there, which again is telling us that we have these prospective mafic, ultramafic intrusions at Mora. Early work to date has been very successful, and we've identified 3 very good targets, which I'll now talk about at Mora. So the Bindi prospect out in the eastern part of the project area, wide-spaced auger geochemical sampling has defined a 6-kilometre long nickel anomaly. This is the same area that Poseidon explored in 1968. Some of their shallow drilling intersected up to 21 metres at 0.6% nickel effectively from surface. There's been no deeper drilling. The fresh bedrock or the sulphide zones have never been tested at Bindi. Our results validate the previous Poseidon results, and we're looking forward to doing more work here. In the southwest of the project, we've also identified a couple of other large geochemical anomalies at Mount Ewell and at Horseshoe. In addition to very anomalous nickel and PGEs, similar to what we're seeing at Julimar and Yarrawinda to the south, we're also getting some very strong gold numbers, which I suppose sets us apart a bit from those other areas. So we're getting up to 600 parts per billion gold in shallow drilling or shallow auger work, up to 75 combined PGEs. So some very exciting results and very large geochemical anomalies. So we're back on the ground. We've just finished infill and additional auger drilling. We're about to sign up for an airborne electromagnetic survey. Electromagnetics has been very successful at Julimar and Yarrawinda at defining sulfide bodies which contain nickel. We'll have the results for that survey by the end of August. We'll just follow that up with further ground definition work with the intention of being drilling at Mora well before the end of 2020. Okay, so just to sum up, Catherine Valley, world-class resource. We have an updated PFS in progress, and the results for that will be out in October this year. At Mora, a brand new emerging mineral province, our initial results have been very encouraging, and we continue to explore there. As I remind you, all our projects are 100% owned, and they're all in Western Australia. So just to finalise, corporate overview, a very experienced board, a good mixture of exploration experience and mining and development experience. And recently we've beefed up our executive teams. Adam Smits is an engineer who's joined us beginning of this year, and he's tasked with taking the Catherine Valley resource from a resource through to feasibility and development. And he's been joined by Craig Hassan, who brings some very strong financial skills to the company. And Jamie Day, our long hard-working exploration manager, he was the man that put all the drill holes in the right place at Catherine Valley. Prior to Liontown, he had spent 12 years with Independence Group, where he gained a lot of valuable nickel expertise, and he's now applying that to the Mora project. In a reasonable cash position, we currently have about $5.5 million in the bank. Hasn't actually changed a lot since the end of March because there's been options exercised, and we've owed some money through another project of about $1.5 million. That's it. Thank you very much.
Thanks, David. Lots of questions, but we won't have time for all of them, so I'm just going to pick a couple.
Make them easy, Nick.
An investor has asked, do you have any off-takes on the horizon or delivery partners?
No. We've deliberately avoided trying to go too far. Listen, we've had a lot of interest and we've had a lot of discussions, but one thing we don't want to do is complicate our life at the moment. We want to de-risk the project technically. We want to keep it simple and clean and make it attractive to a really good partner. So when we do go down that path, we make the right decision. It's probably fair to say things probably would have been more advanced. We had some discussions earlier this year, but obviously with COVID-19 restricting the amount of travel that people overseas could do, has slowed things down a bit. But we're really focused on trying to get the project as right as possible before we get too involved in those sort of discussions.
Right. Another quick one. Where does Baldania fit in the Liontown timeline?
Listen, it's a good question. Fair to say we're looking at it at the moment. It is a valuable resource. It is at surface, and we're looking at it now, and we're trying to work that out ourselves. But we do appreciate the value of the project, and we're not about to give it away or drop it or anything like that. It will be included in our future plans. Yeah.
Fantastic. Thanks very much.
Thank you.
Thanks very much, David. It's my great pleasure to introduce our final speaker today. Pilbara Minerals, a company that needs little introduction to RRS follows. Pilbara Minerals has been a trailblazer for the lithium sector, last year completing a remarkable 4-year journey from first drill hole at the Pilgangoora project to an established producer, which has now cemented its position as a key participant in the world's rapidly growing lithium supply chain. While the lithium sector has experienced significant headwinds over the past year, Pilbara Minerals has done an outstanding job in responding proactively to these challenges, implementing a moderated production strategy from June 2019 and maintaining a disciplined and prudent approach to managing its finances. The company remains extremely well placed to take advantage of a rebound in the lithium market with an impressive network of global offtake and development partners, a strong balance sheet and shareholder base, and of course, ownership of a Tier 1 asset. Leading from the front, as always, is Pilbara Minerals Managing Director, Ken Brinsden, and I'd like to welcome him to the podium to give you an update. Thank you, Ken.
Well, thank you, Nick. You should be doing a presentation. Thanks for the introduction. And ladies and gentlemen, pleasure to be with you. Thanks very much for joining today. It's much appreciated. The usual disclaimer, and you can find an extended version of this presentation material on the web. And I encourage you to go and look at the additional information that we place within our corporate presentations so that you've got a chance to participate in the full story. I'm going to focus today on an update as to where the company's at in respect of our activities, where we expect to go in the short and the medium term. But really the main thrust of today's presentation is to explain some of what we think are the really constructive developments going on in our industry that have the effect of cementing the value in the supply chain that includes spodumene to lithium hydroxide, to the high nickel cathode batteries, which are definitely the story of the future. It's important that we dwell on that because it's the main reason that we think we're in the right game. A lot of you would be familiar with us, Pilgangoora project, relatively rapid development in the lithium world to the point where it's now already a very big lithium raw materials mine, easily within the top 5 around the globe. Producing a quality concentrate, fantastic infrastructure base to work from in the Pilbara, one of the world's great mining jurisdictions. The combination of all those factors has meant that we've attracted a premium bunch of off-takers and participants in our company and in the project. And we feel very privileged to have them on board with us. So currently, at the Pilgangoora operation, it's, as Nick alluded to, it's the moderated production strategy, a disciplined approach to what are relatively difficult market conditions today with a relatively weak demand backdrop. The only prudent thing to do is to back off the production, take some of the pressure out of the market, not have the stocks sitting there in front of your customers. And through that disciplined approach, we've been able to maintain a really healthy cash balance and have ourselves set for the inevitable turn in the market. And again, I'll reference that a little bit more later in the presentation. We're really happy with where the team has got to in respect of our plant production and in particular recovery rates. It's fair to say that that's been a frustrating process, and it probably took us about 6 months longer than we would have liked to get to design recovery, but we're now well there. And when we turn on the plant, we do it with confidence in the knowledge that we're going to get readily achieve 70% plus recovery rates. And as it stands today, we have a production run underway as we speak, and easily achieving the sort of run rates that we've described for design, 72 to 78% recovery, depending on the ore type that we're treating in any one week. So a great performance, second only to Greenbushes now, the old warhorse. The recovery rates that we're achieving are right up there amongst the top 2 globally. So it's a credit to the team, very, very proud of what they've been able to achieve. Why is that recovery so important? Because it speaks to our cost base, so that when we switch the plant on, we can be confident about the cost base that we're going to achieve. And with that, in the short to medium term, our expectation is that we'll get our costs down to sort of mid to low $300 a tonne, delivered to China for a dry product, inclusive of royalties, shipping, sea freight, and the administration component that relates to our site costs. So a fully costed tonne delivered to China, mid to low $300 a tonne, once we get 100% of the operating capacity at the mine. In the meantime, it's steady as she goes in relation to the relatively weak demand conditions. We have a fantastic partner base. They've come to our project for a reason, for all the reasons I alluded to earlier. It's big, it's long-lived, it's a high-quality concentrate. We've had every man and their dog complete due diligence basically on that list as it relates to our project, and I can assure you they're all completely comfortable with both the design and the recovered product, and now the treated product as it goes through their systems. POSCO is a good example where they're using our spodumene in their demonstration plant, which is a pretty significant industrial scale plant, and they're producing the highest grade hydroxide that you could buy in the market today. So again, further evidence that the products are doing all the right things from the Pilbara project. In respect to POSCO, we love the relationship with them, and we're continuing to work with them on the downstream joint venture. And our expectation is that based on the recent rounds of engineering and the work that they have going on both at a project level and through their management teams, that they'll be presenting to the POSCO board during the September quarter. So that's the next round of updates in respect of the progress of the downstream POSCO joint venture. They're a great team, fantastic engineers, and we really enjoy working with them. All right, moving on. I want to spend a bit more time dwelling on the structure of the market, because there is some really important developments there that reinforce the value in the spodumene, hydroxide, high nickel cathode materials. Apologies if this gets a little bit complex, but it's well worth dwelling on. Most of you would be familiar with the fact that there's 2 supply chains. The hard rock supply chain producing a spodumene concentrate, and of course that's where we participate via the Pilbara project. In contrast, there's the brine operations. The competitive advantage that spodumene concentrate has is rooted in its ability to be able to be chemically converted to lithium hydroxide directly. In contrast, brine operations, which fundamentally operate with a chloride chemistry, have to go to lithium carbonate first, and then subsequently have more money spent on them to convert them to lithium hydroxide. So that's the competitive advantage in the spodumene world. Combination of cost to high-end lithium hydroxide, continuity and quality of supply. They're the competitive advantages. Now, a lot of people and a lot of industry analysts have said, well, that's to be seen. Well, I'm here to tell you today that it's already happening. And there is evidence to indicate that spodumene is getting deeply rooted into the hydroxide supply chain. On the left-hand side of this graph, we're looking at exports of lithium hydroxide from China to Japan and to Korea. Probably leading edge as far as high nickel cell making capacity is concerned. And in the last 2 years, there has been 4 times growth in lithium hydroxide exports from China to Japan and Korea. Why is that important? Well, almost universally, that export capacity is delivered via the spodumene supply chain, chemically converted directly to lithium hydroxide. So 4 times growth in 2 years. deeply rooted in the spodumene supply chain. By the way, it's not a coincidence that within that 2-year period, roughly, it was equivalent in demand growth to the scale of our stage 1 Pilgangoora project. In just 2 years, the equivalent capacity of our Pilgangoora stage 1 project was consumed. So it's happening, and it's happening quickly. Then when you dive a little bit deeper into the data and you look at Korea, what you find is that it is absolutely the case that spodumene converted to hydroxide has been cutting the brine operations lunch. They've been stealing market share. In fact, arguably, the brine share of hydroxide has actually been falling away in comparison to the spodumene-sourced hydroxide. To me, the combination of those two things indicates that the spodumene is now deeply rooted in the supply chain. The link to hydroxide, the consumption of the hydroxide in high nickel cathode materials, it's all well underway, and hence the importance in our future. And what does that future look like? Well, it's a big deal. They are moving incredibly quickly, and some very, very strong incentives have been set up for the average consumer buying a car in Europe to buy an EV, to the point where it's probably in the range of 30 or 40% of the cost of the car is now being supported by an incentive. So very, very bold moves, really important for the future of our industry. And why is that so? That's because all those cars, well, virtually all those cars being sold in Europe will be based on high nickel cathode chemistries. It's a really important development for the industry, and it explains why the Europeans are now actively scouring through the North Asia, Japan, Korea, China, for the combination of battery raw materials, cathode materials, and of course, cell making capacity. And Europe's becoming particularly important quickly. In fact, by UBS's estimate, this year, the market will overtake China in terms of consumption of EVs or the take-up of EVs. So a very important market happening quickly. And as I alluded to, particularly important because those cars will have high nickel cells in them, and hence the link to the historical consumption of hydroxide and spodumene as a result. So very, very important market developments. So what does that mean for the future? Well, the reality is we're just at the beginning. I mentioned earlier that in the last 2 years, roughly speaking, the amount of hydroxide grown in capacity related to about our stage 1 Pilgangoora mine development, which, by the way, is one of the top 5 mines in scale. And that happened in 2 years. And then where are we headed in the next 10 years? Well, for the amount of hydroxide expected to be consumed, you need 25 Pilgangooras. 25. Now, I can tell you, there is no way that today, at least, 25 mines of that scale are going to be developed in a short enough period of time to satisfy the wave of demand that's coming. And then, of course, the situation gets more and more acute over time. 75 Pilgangooras are required in the next 20 years. It's big law of numbers, and there needs to be a lot more mine development, and I suspect that the industry is going to get caught short. That's why we are confident that ultimately we're in the right part of the supply chain, and we will benefit from those market dynamics. In fact, you could arguably see some of that already happening. I don't know how many of you have been watching Ganfeng, but Ganfeng's a key hydroxide participant in global markets, Japan and Korea, and their share price has taken a really big run in the last couple of weeks, and it's happening because of the sourcing that's starting to emerge in global markets as everyone thinks about accessing battery raw materials. So what are we doing from here? Well, we're further refining our stage 1 operations. We're really proud of where the team's got to in respect of recovery. So as I said, second only to Greenbushes, very, very high recovery rates being achieved. That's important because it speaks to low cost. It's such a large resource and reserve that we've got the opportunity to continue to keep growing the mine as and when the market demands it and our customers need it. And of course, we continue to work on the projects that will ultimately deliver those expansions. We're also working very hard on the relationship in joint venture with POSCO on a downstream facility in Korea. That's an important part of our future, and we look forward to having more to say about that in the coming months. Thanks very much, ladies and gentlemen. Appreciate the chance to be with you this morning, and I look forward to your questions.
Thanks very much, Ken. Again, lots of questions, so I'm just going to cherry pick a couple. Firstly, an investor has asked, can we expect General Lithium to start taking stage 1 offtake later this year in line with the establishment of their new 60,000 tonne per annum lithium hydroxide plant?
Yep, no, good question, except the premise is probably not right. They have been taking offtake. The question with respect to the offtakers is their ability, in light of the current market conditions, to take the entire offtake position. But as to General Lithium, Ganfeng, Great Wall taking their tonnes, the reality is they've been taking some of their tonnes, just not all of their tonnes. Now, our position in respect of that is to just remind them, obviously, that they're not compliant with respect to their contractual position, but we also choose to continue to keep working with them because fundamentally they are still the best customers, the groups that are best integrated into the important parts of the battery supply chain.
Thanks very much. Another possibly slightly related question, an investor has asked, the SC6 lithium price was over $1,000 US a tonne when Ganfeng, Great Wall and POSCO agreed to their stage 2 offtake options. Is it reasonable to expect that they will continue, or will stage 2 finance require an alternative strategy?
Yeah, well, I can tell you, as much as we might fret about the current state of the market, it hasn't stopped any of our partners continuing their investments in respect of battery raw materials. So to highlight POSCO, I'd say they've been very active in the nickel sphere, the cobalt sphere, still building out demonstration plant capacity, optimising that. They're all significant investments that are being considered for the medium and the long term, not the short term. CATL is another good example, billions of dollars being spent on the combination of their supply chain and cell making capacity. And Ganfeng's about to commission another round of expansion capacity in the fourth quarter of this year. They're just on the public record in the last couple of days restating that. So do they and others for that matter require additional capacity in the short to medium term? I think the answer is absolutely yes.
Thanks, Ken. Maybe just one more before we let you go. An investor's mentioned that in your quarterly you flagged a possible restructure of your bond or a refinance. Can you give us a bit of colour about what your options are there and where that process is up to? Yep,
good question. So our objective in refinancing is ultimately to lower the cost of the debt facilities that support the company. You'd be familiar with the history. Nordic Bond established pre-development and supported the construction of our stage 1 facilities. But of course it came at a relatively high cost. So there is merit, especially now, having gone through the first non-call period, which means it's less costly to replace the facility or at the very least change the facility, and therefore an important objective for the company. We're working hard on it. We still have quite a few options in front of us, combination of working with existing bondholders, a completely new financing facility, or a hybrid that involves strategics that participate in our business, whether they're off-takers or investors. So an important package of work, something we're continuing to work hard on, and probably more to say about that in the coming quarter or two. Any rough timeline on when that might be? Well, it's difficult to be definitive, but hopefully we'd have more to say about that during the September quarter. Fantastic. Thanks very much, Ken. Thanks, Nick. Thanks, ladies and gentlemen. Well, thank you very much. That concludes our presentations for today. I'd firstly like to just extend a big vote of thanks to Rob Riley, Chris Cairns, David Richards and Ken Brinsden for 4 outstanding presentations. And finally, a big thank you to everyone who tuned in today. Your support and participation is greatly appreciated. A reminder that a recording of all 4 of these presentations will be available and released via YouTube and our social media channels over the next day. And of course, all 4 of them will be in our RRS weekly wrap on Friday morning. If you're not already signed up, it's never too late. Our next virtual investor series is scheduled for Wednesday, July the 8th, and we'll be in touch shortly with more information.
Thanks for your attention and enjoy the rest of your day.